If I Were the Devil, January 30th, 2026, COMEX edition. With iBanker U, apologies to the late, great Paul Harvey. Please share far, wide, and often. This is a fun one. If I were the devil and wanted silver without paying a clearing price for it, here is what I would do. I wouldn't fight the market. I'd let the math do the violence. Because silver doesn't trade on sentiment. It trades on constraints. And constraints fail not linearly. COMEX silver is a highly leveraged system with embedded convexity. Open interest represents many multiples of deliverable inventory. Registered stock are not supply. They are optional supply, contingent upon price, margin, and confidence. Most participants aren't long silver. They're long continuity. They expect the contract to roll, net, or settle without stress. January threatens that assumption. By late January, the market wasn't mispriced, it was fragile. Fragility is when small changes in volatility produce large changes in required behavior. And silver was sitting right on that boundary. If I were the devil, I wouldn't target price levels. I'd target VWAP deviation. Because VWAP isn't just a benchmark. It's a continual constraint embedded in execution algos and post-trade evaluation. When price trades persistently below VWAP, buy-side participation drops even if valuation improves. Not because managers are bearish, because negative slippage is career risk. VWAP converts uncertainty into passivity. Passivity thins the book, and a thin book increases impact elasticity. Now let's talk about the order book. Display depth is not liquidity. It's information. Large orders are spoofed. Large offers are spoofed. They appear, cancel, and reappear. Size clusters above price. Then steps away. Whether intentional or not, this behavior signals persistence of supply. Machines don't ask about intent. They measure order to trade ratios, replenishment latency, spoof likeness metrics, Q depletion speed. When those variables degrade simultaneously, liquidity provision switches from aggressive to defensive. Bids widen, depths decay. That's not panic. That's model compliance. Once bids retreat, silver discovers price not smoothly. It forms air pockets. Air pockets are regions of low resting liquidity where small market orders cause outsized price movement. Air pockets don't need volume. They need absence. Price falls into the air pocket. That fall increases realized volatility. And this is where the system flips. Volatility feeds directly into value at risk models, initial and maintenance margin schedules, risk parity exposure scalars, CTA trend and breakout logic. These systems don't ask why, they ask how fast. Once realized volume crosses a threshold, exposure is reduced by mandate. This is the first puke point. The second puke point comes from gamma. As silver falls, dealer positioning transitions from long gamma to short gamma. And at that point, hedging flows amplify price movement instead of dampening it. Down moves create more selling. Up moves fail to attract bids. Convexity turns hostile. Now layer in January 30th specifically, because this wasn't happening in isolation. LBMA liquidity was thin. Shanghai was closed. And reports circulated that HSBC bullion clearing systems were temporarily offline. No conspiracy required, just correlation. When global arbitrage pathways constrict, local stress matters more. Delivery optionality becomes binary. At this point, the question is no longer, is silver cheap? The question is, what is the cost of being wrong right now? That cost is margin. That cost is operational risk. That cost is being forced to act later instead of choosing now. So funds act, they roll, they liquidate, they flatten. This is not a thesis change. This is a risk mitigation under constraint. This is the main puke. High volume, high volatility, low discretion. And here's the key signal. Selling continues, but price stops accelerating. That tells you something important, because entities with unconstrained balance sheets don't see volatility as risk. They see it as inventory transfer. When forced sellers exhaust themselves, flow changes. And when flow changes, so does price behavior. This is where shorts get covered, not because models say buy, but because models say the cascade is over. Volatility peaks, then decelerates, impact per contract declines, bid replenishment stabilizes, the convexity flips again. That's the bottom. No bell, no headline, no announcement, just math returning to equilibrium. After that, everything looks obvious in hindsight. Margins stop rising, VAR stabilizes, CTAs stop pressing, liquidity reappears, silver trades higher, not on fundamentals, but because forced selling has ended. And then the narrative machine wakes up. Normal volatility, healthy correction, nothing to do with delivery, nothing to see here. But January 30th wasn't random. It was deterministic. It was what happened when VWAP suppresses demand, order book signaling reduces liquidity, air pockets increase impact, volatility breaches risk limits, margin ladders force liquidation, global clearing pathways narrow, and all of them at once. If I were the devil, I wouldn't need to cheat. I just need to understand convexity, constraints, and timing. Because in silver, the real price is not the last trade. It's the price at which everyone who had to sell already did. And now you know the rest of the story. iBanker News. Good day. Please join us later tonight when we premiere iBanker News Tonight. Subscribe if you're new and check out all the videos. Bonus points if you put who you think the devil is in the comments. Day 10 in the books, and as always, build that stack!